Many investors look for ways to diversify their portfolios, and one way is through options. Stock options are financial contracts that grant the buyer the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified time frame. Now, option investing has surged since the pandemic, with the retail share of options trading is rising from 35% at the end of 2019 to 48% just 6 months later. And that number is declining from its peak, sitting around at 42% right now. All of this data compiled by the New York Stock Exchange, by the way. But despite the rise in popularity, we're posing this question: is options trading for all investors? Does it belong in your portfolio? And here to help answer that question is Jim Strugger, Kineo Capital Managing Partner. And this is part of Yahoo Finance's Option 101 Theme Week, sponsored by Tasty Trade. And Jim, we've been throwing some definitions out here, and we want to talk about everything, but just an opening line to our viewers.
One would be, if you get into options, number one, it requires a certain degree of focus and activity because options expire all the time. And the other would be understand your risk. Before you enter into any position, structure it as defined risk if you're brand new to these markets, but most importantly, understand what that risk is, what it looks like for various outcomes.
Great. Manage your risks, my number one mantra in trading. So let's get to this. Investing in options, these are some decisions and things that you'll have to think about before getting into the trade, including the underlying stock. And I put S in parentheses because you might have multiple stocks involved in the trade, but we can go through the directional bias, the strategy. Just talk to us about some of these things, some of the considerations that investors should have for their portfolio.
Sure. One consideration, you have directional bias. Is this a directional trade? Are you coming in, making a directional decision, buying calls, buying puts outright? Or is this a trade where you're seeking to take advantage of implied volatility being elevated, where you're short vega or short volatility and extracting premium from the market?
All right, we're throwing around a lot of inside baseball terms here, and that's fine because options involves a lot of this, and we want to break it down. So when you're talking about implied volatility, this is the amount of volatility that we're expected, that the options market is saying, we expect the underlying stock to move by this much. And how does that factor into your determination of what to buy an option price at?
You want to understand where implied volatility is relative to itself, and then also realized volatility, which is actually the volatility that's realized looking back over the course of time. Quick example, Microsoft reports after the close today.
Yes.
Options that expire this week are twice the implied volatility that they would normally be. The market expects a fair amount of volatility on earnings, even though it is Microsoft. That's something any option trader needs to understand before they enter a trade.
Great example, and we're going to get to our next page. Just want to point out that we have to consider expiration dates and strike prices. And let's give an example. Here's Tesla, where we have an options chart, profit and loss, and this is for a Tesla call at the strike price of 210, expiring the monthly expirations on March 15th. So just kind of break down this trade for us.
Sure. Tesla reported last week, unspectacular earnings report. They're overproducing. They've taken down the cost of their cars. Doesn't look great. Stock's down 30%. Over the last month. You've got people like Kathy Wood, who runs ARK, coming in buying $150 million worth of Tesla. If you want to express a long directional view in Tesla right here, implied volatility is in the right place for that because it's as low as it's been in 5 years. So it's about 40%. You really won't find it lower. So if you're paying up for premium, whether it be calls or puts, a good time to do it. In this case, we're talking about going out to March, buying the 210 strike call outright. For that long directional exposure, break-even's about 11% higher from here. But again, stock down 30% over the last month.
All right, great. And we want to get to another example. This one involves a covered call. This is where an investor sells a call option at a set price and expiration date on a stock that the seller owns in an equivalent amount. So key there is that you already own the stock. And the example we're showing here is NVIDIA, where we have a covered call option at the 700 strike price expiring February 23rd, that's a weekly. Just kind of break down this trade for us.
Sure. Important point here is that the statistical edge in option markets is on the side of the seller. right? So here you have NVIDIA, they're going to report on the 21st of February. We're using the Feb 23 expiration. We want to sell the 700 strike call. It creates a situation where if the stock happens to be above 700 at expiration, it's going to be a 13% total return over the 3 weeks to that expiration. If the stock is below 700, we just pocket that premium. It's about 1.5%. So in a lot of ways, it's a win-win if you're willing to sell NVIDIA stock up another 13% 3 weeks from now.
All right, put quite well, and thank you for your time here, Jim Strugger. Appreciate your insights.